Okay, hey everybody, welcome back. I hope you guys had a good spring break. I felt like it was nice and long, like it was a good spring break. I mean, you guys, and nice weather, so even if you just stayed at home, like staycation, then felt like you were getting a little spring break. Okay, so we are now shifting over to inventory. That's the last topic before the next exam. Okay, so we have this whole week of just talking about inventory, then a review session, and then an exam. And then we'll have 2 or 3 more chapters to go of the text, and then the final exam. It's not a final outside of class. It's like a third midterm, okay, which is good. And it's really focused just like, so this exam will be focused on the last 3 chapters. There's some sense in which accounting is cumulative, right? I'm not going to say, I will not ask you to make journal entries. Of course I'm going to ask you to make journal entries, even though that's something we learned in the beginning of class. However, I'm not going to say create from scratch an income statement. I'm going to be focused primarily on time value of money, cash, accounts receivable, and inventory. Okay, one thing, was that a hand or that was, no more quizzes? Okay, I will give back the quizzes today if you'd like to pick them up. I did want to just talk about one problem from the quizzes before we head over to inventory, which is something that, the reason I want to talk about it is I think it's important that you, even if you're a calculator, financial calculator person, there was a problem on the quiz which your financial calculator would have needed a lot of help from you, okay? And so I in some sense, put that question in there because I think it's really important that you, even if you use a financial calculator, you understand what the process is and what needs to be done, not just I can plug in I can plug in N, I can plug in P, and then I'm done, okay? So the one problem that I'm referring to is there was a situation where, I was asking you, which is better? Should I buy the asset outright? Should I lease it under one set of conditions? Or should I lease it under another set of conditions? And we don't need to solve the problem together, but let's just sort of talk about what the issues are. Okay, so problem says, should I buy it? If I buy it, it would cost me $2 million. So when I'm comparing buying versus leasing, I'm thinking about, well, I could shell out $2 million right now. So when I think about leasing, what would be the necessary comparison I need to make? Okay? So when I say which would be better, buying it or leasing it, how am I going to decide? What do I need to do to the lease payments to make it a fair comparison? I need to compute the present value. So what is the value if I shelled out the money today, right? Because that is what I would be doing if I buy it. If I buy it, I'm giving the money away today. So I need to figure out, well, what would the value be if I gave out the money today of that lease stream? So yes, of course, I'm going to end up paying more than $2 million under any lease condition. But is it worth? Are the payments worth more than $2 million? And that's the important question. So there was lease 1, okay, which was basically you start making payments immediately, right? Okay, $200,000, and you make 20 of those. Okay, so 20 payments. Now, in just nominal terms, how much cash am I paying for that $4 million, right? But is $4 million over 20 years worth more or less than $2 million right now? So what do I do? What kind of problem is that? Straight up annuity, is it due or is it an ordinary annuity? It's due, right? So this is just an ordinary annuity. This I can easily handle with a table, and I only need one table. I only need a couple of punches into the calculator. I only need one formula. It's pretty easy, okay? And most people got this right, okay? And then they could just say, which is better, this or this, and that was fine. And then there was a little trick question. I don't want to say trick, but I'm trying to make sure you understand the concept, not just this issue. And it's, well, okay, what if instead the lease payments, so we're standing right here, okay, this is today, and I say, well, you don't have to pay for the first year, you don't have to pay for the second year, but then in year 3, you start paying. But now you have to pay $250,000 per payment, but you only make 18 of those payments. Okay? Now, in terms of nominal dollars, like actual dollars paid, how much is this? $4.5 million, right? So it's 18 payments, but each payment is $250. Okay? Is this, which is better, this or this? Or this? Doesn't matter. Well, nominal terms is kind of irrelevant, right? So we know, obviously, if somebody says, hey, you don't have to put any money down, just pay me later, what's implicitly happening? They're going to charge you interest. It's just going to come out in these payments. So, of course, it shouldn't be a surprise to you that these payments are higher, right? Because you're making fewer payments and you're putting it off, right? Obviously, if they gave you the deal, give us fewer payments and pay later, you don't need a calculator to figure it out whether that's a better deal or not, right? We could all agree right up front, if these payments stayed at $200,000, we're done, right? So that's not relevant. The issue is now, of course, there's a cost of waiting and the cost of fewer payments. How do I do this problem? Yep. Okay, so I could pretend I'm standing right here. Okay, this is me here. And I could say, now this is an ordinary annuity. This is an annuity due. This is 18 periods, 10% interest, so on and so forth. Okay, so annuity due, 18 periods, 10% interest. Am I done? Why not? Because that's the present value of this annuity here in year 3. But is that worth more or less than what it is today? Well, the cost to me is actually a lot less because I don't have to start making the payments right now. What I've computed is what it would cost if I made $250,000 payments starting right now. But I get this whole nice deferral period. So what do I need to do? I need to take the present value of this stream of payments and discount it back. So I need 2 tables, right? So I would basically first use this annuity due table and then discount it back to the present using a lump sum formula. Okay? You can use your calculator, but you can't do it all in one step. And I need to make sure that you really understand, because it's not just, can I use a financial calculator? That's not the goal of this chapter. Okay, it's also not the goal of this chapter to see whether you can kind of use any of the tables in the book. You've got to understand the difference between these 2 deals and why we need to compare the value of them today versus the value of them in the future. Okay, so I have your quizzes. I will hand them back, and I will also post. I don't think I did it yet, but I'll post the solutions to the quiz. So in case you did not get this part C, you can understand how to do it correctly the next time around. Okay, so that's enough about this. So today we're going to talk about inventory. Now, there are a bunch of different issues, and they seem a little bit disjointed or unrelated, but we're just going to try and sort of tackle each piece slowly and carefully and try to understand how inventory works in a financial reporting system, okay? You've all taken managerial. You've all spent some time understanding how you allocate costs to products, right? That was sort of the primary focus of managerial, right? How do you decide which costs go to which product? And that's not what we're interested in here. It's not that we're not interested in it. Obviously, it has to be done, and it has to be done correctly. But we're going to just sort of assume we know how it's done and assume it's done well, and then ask ourselves, what does that mean for how we put value inventory on our financial statements? And what does that mean for our cost of goods sold on our income statement? So we're not really going to focus on how and why you allocate different costs to different products. We're just going to say, here are the costs that need to be allocated. Okay. Now, when you're talking about a manufacturer, you've got a very different set of inventory issues than when you talk about just a pure retailer or a merchandiser. So if I sell goods that are already in the state that they need to be in, then what costs are there associated with those goods from my perspective? So I'm the seller. I don't make the goods. I buy them from a wholesaler, and then I sell them to my customers. So what kind of costs am I incurring when I buy the goods from my wholesaler? Yeah. Okay, so the product cost. Okay, what else? Shipping, right? I have to pay shipping. What other things might I pay? Storage. I might have to pay some storage costs. Okay, what else? Sir? Insurance. So in the process of shipping, I might insure the product. Okay, I might have to pay some sales commissions. When you go into a store, do they charge you exactly the price that's on there? Taxes, right? I have to pay taxes. So all those things. Now, when I think about selling it to the next person, right? So I am Target, a retailer. I go to Procter & Gamble and I buy a bunch of toothpaste, and now I'm going to go sell it to you customers. What do I need to make sure that I get for the product? At least enough to cover all of those costs. I can't sell you the tube of toothpaste just at the product cost if I paid taxes on it. Okay, I can't sell it to you just at, I have to charge you for all those things, right? I'm passing them on to you. Plus, I'm also going to hopefully charge you a little markup so I make some money. Okay, but realistically, the cost of the product is all of those costs. And when I start being profitable is any amount I charge above and beyond all of those costs. Okay? So when we think about a retailer, we're going to think about the cost of the inventory, including all of those taxes, insurance, commissions, I don't know, whatever other things, freight, those kinds of things. Okay? On the other hand, when we have a manufacturer, things look a little bit different. When they buy from a wholesaler, they're buying a product that ends up looking extremely different, or starts out looking extremely different from what the product they finally sell is, right? So let's say we're manufacturing wooden tables. We buy planks of wood. We need to also buy screws and nuts and bolts, I don't know, whatever stuff you buy for table making. Okay, we work on it, and then we send something out the door that looks very different from what we ended up purchasing. Why does it look different? It's not just that I added some screws to it. What else did I add to it? Labor. So I got the raw materials, the screws, the nuts, the bolts, the glue, whatever. What else? I mean, I needed some guys, machinery, the machine kit, all right? So yes, if it was all handcrafted by like an individual with a little chisel, that's fine. But realistically, there's probably some sanding and planing and, I don't know, sawing and whatnot. So that final product is getting the benefit of all of those items. So the real cost of the table is not just the cost of the wood and the screws and the glue. It's the cost of the guy working on it. It's the cost of the saw. It's the cost of all those things. So when I think about how much should I sell that table for, I better cover all those costs. And to get a realistic notion of what the cost of my inventory is, I need to add all those costs together. Okay? Now, you might think, oh, this is a violation of historical cost because we're writing up the value of the inventory. We're not. We're not writing up the value of the inventory. The inventory has changed. It went from being a piece of wood to a table. And the way it became wood to table was we incurred additional historical costs. So when I think about the cost of my inventory, it includes all of those costs. Okay, it also would have included shipping and insurance and commissions and so on the raw materials, but it now also includes the cost of the materials, the cost of the labor, and the cost of the overhead, including depreciation on my machinery, utilities for the factory, and so on. Yes? Okay, so that's an important question. If I'm saying the cost of the labor is really attaching to the product, right? So what does that mean? That means I don't record a salaries expense. Now, I don't record a salaries expense because instead I'm considering that expense as part of the inventory. Does that mean I don't have to pay my employees? Like, are you going to show up to work every day if your employer says, we'll pay you as soon as we sell the product? No, it doesn't work like that. So what does that mean? It means I don't record the expense, but of course I still have to record the payable or the cash going out. Okay, that's the whole point of accrual accounting. The expense will show up in the period in which I sell the product, and it comes out through cost of goods sold. But the cash payments, the salaries that I need to pay my employees every 2 weeks, no matter what. Remember, Bill said, what is the most important thing when you're a little company? You've got to make payroll. He didn't say you got to pay your suppliers. I mean, you do need to pay your suppliers, otherwise you get the phone calls. But what is the most important thing? If you don't pay your people, they don't show up at work. If they don't show up at work, you don't have a company. So you have got to pay your people, even if you don't sell the goods yet. So you got to have enough cash to pay them, but their efforts aren't necessarily going to be charged against your income until you start generating revenue. Okay, so you'll see how that works in a second. All right, so this is what I mentioned about the costs that need to be included, and this is whether they're raw materials or you're buying finished goods, but you're going to include not only the purchase price but shipping costs, handling costs. If they say, hey, you usually see S&H costs. That's the handling, whatever bogus handling there is. Insurance, warehousing, spoilage, all those things. Now, you're only supposed to include the costs that are necessary. So if you, for example, decide to buy way more stuff than you need, and you say, well, you know what, I'll just ship it halfway, keep it in a warehouse for 6 months, and then when I need it, I'll ship the rest. Those warehousing costs, those aren't part of the product cost. Those are optional voluntary storage costs. It's only the cost necessary to get the product ready for use. So if, for example, you buy and distribute wine, okay, and there is some requirement from the seller that you store it for, it can only be released after a particular date, well, then that's a necessary cost. Whereas if you just choose to store it yourself, that's a voluntary cost. Okay. Remember we talked about discounts when we were talking about receivables. If you offer a customer a discount, they may or may not take it. If you are a purchaser and you are offered a discount, and you also may or may not take it. Okay. The same thing that applies for receivables applies for the inventory. So if you purchase something at an optional discount, you can record it using the gross method, which would say, I record it at what I think, the actual invoice price, and then if I take a discount, I just reduce the cost of my inventory for discounts taken. Or I can record it at the net, which would be, I assume I'm going to take the discount, so I record the inventory up front at a lower cost. And if I fail to take the discount, then I would just charge myself a period cost for, discounts missed. Okay? So either one is fine. This one is sort of recognizing the fact that if you don't take the discount, you're going to take a hit on income right away for sort of bad cash management or bad discount. So this would be sort of putting yourself a little bit more at risk, but on the other hand, it encourages you to actually effectively take cash discounts when they're offered, or early payment discounts. Okay, so the whole reason that we're sort of adding all these costs together into your inventory is matching, right? Matching says we should recognize costs in the same period as the revenues they produce. So why am I buying these supplies? Because I'm going to sell them later. So they start out as an asset, and then eventually they become an expense. Why am I buying the shipping associated with those? Same reason. Okay? So it sort of starts out as an asset, which is the inventory, the total cost of my inventory, and it only shows up as an expense when I sell the product. Okay? So that's sort of, and then you just follow that logic for a manufacturer, which would also be adding the cost of labor, the cost of depreciation, the cost of manufacturing overhead, and so on. Okay? So think, this is sort of the way you want to, I mean, I'm sure you've seen this before, but this is the way you want to think about inventory from a manufacturing perspective. Okay? You start out with raw materials. All manufacturers tend to keep their inventory in sort of 3 separate financial accounts. Right? The raw materials are all of the input purchases that come in as individual items. You're going to take those individual items, do some magic, and then boom, they're going to be something else. Okay? So you start out, as you buy raw materials, you would have raw materials go up and cash goes down. Okay? Now, unlike normal inventory, we don't just sell the raw materials to somebody else. We're going to first work on them, and then we're going to sell them. Okay? So at some point in my factory, somebody calls up the raw materials warehouse and says, we're ready to start working on it. Send the stuff over. Okay? So then we basically, not only physically, but from an accounting perspective, transfer goods from the raw materials account to the work in process account. So let's say they said, hey, send over $500 worth of lumber. So what am I doing? Well, I'm putting in work in process, and I'm taking it out of raw materials. Okay, so let's say I do something like this. Now, why did that happen? Well, because they're going to start working on this stuff. Do I still have $500 worth of raw materials? Or do I still have those materials, and are they still in my company? Yes. Okay? But instead of calling it raw materials now, I'm just calling it work in process, but it's still there. Okay? It hasn't disappeared. Now, of course, there may be some, scrap material and so on and so forth, and you may say, oh, well, it's not actually worth, don't worry about that. Okay? So then my employees start working on it, and I pay them salaries. Okay, so they're working on this table that we're making, and I have work in process, salaries payable, or cash. Okay, so let's say I have a couple of employees, their time is $100, they've been working on the table. It's now looking almost table-like. Okay, so I would be adding to my work in process. Now, this is different from a retailer, right? If you've got employees or salaries working for you, or employees working for you, you just record salaries expense, salaries payable. Is the fact that I'm doing this, does that mean I don't have an expense? So the fact that I'm calling it work in process instead of salaries, does that mean I have no salary expense? Okay, I have an expense, but I don't record the expense until when? Till I sell the product. So will I see on this company's income statement a line that says salaries expense? No, I won't. Will I see it somewhere in like SG&A if I broke it down? No, I won't. Where are the salaries expense going to show up for a company that's a manufacturer? Embedded in the cost of goods sold. Now, I'm also using a saw and some other equipment in my table making. So each year that saw is kind of getting a little bit duller, and after 5 years it's not going to work anymore. So I've used a year worth of sign. The depreciation on that asset is, say, $50. Normally, under what we have done so far in class, we've just recorded depreciation expense, accumulated depreciation. We don't do that here. What do? Well, we add it into the costs of our product. So again, work in process, accumulated depreciation. The credit is the same, but the debit is going into work in process. Why? Well, I'm trying to capture all of the cost of production in work in process so that at the end, when I finally sell the asset, I'm matching all of the costs of creating the asset to the cost to the revenues that have been generated. Okay, so here are a bunch of costs. Now I also have heat, light, other kinds of gas, something, whatever utilities I pay, I would include those too, and any other manufacturing overhead. Now, what counts as manufacturing overhead? What has to actually do with manufacturing? So it's not like the CEO's salary, or it's not the computers used with the sales force, or it's not the computers used for purchase. It's the computers used in the factory shop. So if we have some computers that are required to run the factory, the depreciation on those would be allocated to the inventory. However, if so you may say, oh, you have some computers that are depreciated one way and another. That's exactly right. Okay, if it's deemed manufacturing equipment or manufacturing labor or necessary for the manufacturing process, it would go into inventory. If it's anything else or peripheral, it would not. Yeah. Okay. Depends on what the administrators are doing. Are they administrating the factory? Yes, they go in there. Are they administrating the CEO? No, they do not. It's completely factory, non-factory, right? So it's all, it can be direct or indirect. You don't actually have to work on the product for your labor to count. You can be the production supervisor, but you cannot be, the CFO, okay? Then your costs don't count. Okay, so this is my work in process. Then you're finished. These goods, after you've worked on them enough, they're done. We've got a bunch of tables sitting in our work in process area. What should you do with those tables? Should you just leave them there? That's probably a bad idea, because if you just leave them there, you're not going to be able to sell them, right? So you want to send them over to your showrooms where you're selling your tables and you're showing everyone what you have. Or at the very least, they're available for sale. So you would transfer them to finished goods. So they move over to finished goods in clumps, right? You don't just, you move them over in table units, right? So each table, let's say, cost me $200. So if I'm finished with one table, I move it into finished goods, I would move the table over. How would that look? Well, I just do finished goods, $200, work in process, $200, and I'm just taking $200 out of there and putting it in there. That's the cost of a finished table. Okay? Then what happens? I sell the table. Somebody comes to my showroom, they see it, they're like, wow, this is a beautiful table, I want it. I'm like, sure, no problem, $500. Then we record the sale, okay, and we get cash of $500, sales revenue, and eventually I have cost of goods sold, 200, finished goods inventory, 200. Okay, so what's happening is, finally, when I make the sale in that same period is when I record the cost. That cost includes, this cost of goods sold has a little of everything. It has raw materials, it has labor, it has depreciation, it has other overhead. It's all bundled in there. So when you look at big manufacturing companies and you say, how is it possible that these companies with huge amounts of fixed assets don't have a line item on their income statement for depreciation? What is the answer to that question? How is that possible? You have a company and you see it has an enormous amount of PP&E. You see it has an enormous amount of accumulated depreciation, so they must have depreciated those assets. Where's the depreciation expense? In cost of goods sold. It's in there. It's just embedded in there, and it gets recognized instead of every period. It gets recognized as the goods are sold. Is it really a problem that it's not recognized every year? Well, not really, because inventory is a current asset, so it should turn over at least once a year. So, yeah, it could be a little depreciation from the previous year is recorded this year, and so on and so forth. But the whole point is we're matching the revenues and the expenses. Okay, and that's the idea. Okay, so what would a company show you about itself? Well, here's an example. So this is Dell. Apple didn't have a nice one. They didn't tell you anything about their intermediate products. So they start out with production materials, which are, the inputs, the raw inputs. Then they have, they start working on them. When do they start working on them? Well, when someone calls up and says, can you please, make me a computer with these specifications? And then they have a bunch of finished goods, which they're able to sell to their customers. Okay? So their inventory, now this is kind of what we would expect for a company which says they sort of make the specification, right? They shouldn't have a whole lot of finished goods or work in process, but they should have a lot of raw materials to be ready and able to make it as soon as you call up and order your specific computer. Okay, they've moved somewhat away from that model, so that's probably why it doesn't look quite as little finished goods as you might expect. Okay, now a couple of other issues. Let's say, and this always happens, it's always at the end of the year, you're sort of like forced to close your books. It's December 31st. And normally, December 31st is kind of convenient because it is like a day that nobody's doing anything. But let's suppose you close your books on February 28th. Okay, the last day of so it's a regular work day. It's just one day out of any in the year. Life doesn't stop just because you close your books. So you called up and you asked your supplier for 10,000 units of product 2 days before. And they said, sure, we'll ship it out tomorrow, and it's in the shipment channel. Don't know exactly where. It's tracking it. UPS says it's in Scranton, PA. Is it yours or is it your supplier's? Okay. Is it yours or is it theirs? Depends. Now, why do you need to get this right? Well, you need to figure out how much inventory you have so you can figure out how much inventory you don't have. Now, if you just count up what's physically in your space, you might be missing some of the stuff that's technically yours. Okay? So there's two terms. There's something called FOB shipping and FOB destination. Anyone know what FOB stands for? Yeah? Okay, sometimes you'll see free on board or it's freight on board. Okay, so it means it's in the process of being on board something. Now, that would be in the old days when there's like a vehicle that's transporting it. Okay, if you don't actually have those sorts of transportation issues, these things become irrelevant, right? So if we're talking about Audible transmitting its inventory, it's not a question of where it is. It's instantaneously from their space to your space, right? You don't have to worry about them transferring it with some shipment of disks. But in the case of physical goods, you need to ship stuff. Okay, so what does it mean if I buy something with the terms FOB shipping? Okay, I'm not really worried about who's paying the cost so much. I'm worried about who owns the inventory at which point in time. So when does the seller stop owning the inventory and when does, so let's make a little timeline. Okay, so I place the order here. Okay, it is shipped here and it arrives here. Okay? When I place the order, whose goods are they? Are they mine? So let's say I place the order and I give them my credit card. Are the goods mine or are the goods theirs? What do they do when I first place that order and give them my credit card number? Do they record unearned revenue? They can't record sales revenue because they have a liability. So what do they receive? Well, they get cash, effectively, which is by credit card. Okay, so let's say 1,000. And they have unearned revenue. Okay, next day, they ship. Now, some companies won't actually charge you until they ship, so they don't have to do the unearned revenue and then switch it to revenue. But okay, let's just say this is not one of those companies. Now, it's shipped. Whose goods are they now? Okay, well, FOB shipping means the minute I'm shipping them, they belong to the customer. Shipping, so as soon as it's in the shipping channel, they transfer ownership. Now, it's not a matter of legal issue. This is sort of like economically, they're mine. Okay, I bear the cost. So if they were to blow up along the way, I would bear the cost of them. Okay, so as soon as they're shipped, if they're shipped under FOB shipping terms, they become the property of the buyer when shipped. Now, you might say, well, that's bizarre because how could you possibly own it if you don't actually have it, right? Isn't possession 90? That doesn't matter. Okay, the fact is they are your inventory. You could conceivably sell them at this point and just divert them somewhere else, right? They are yours to sell. They are legally and economically yours, okay? On the other hand, if we use the contract terms FOB destination, this says they are not mine until they hit my loading dock, until they arrive at my destination and get checked in. Yeah. It's not, so the sale is completed sale at this point, and it is now the goods are the responsibility of the customer, okay? So if something were to happen at that point, you as the buyer would have to replace them at your own cost. Now, that's why you would pay for insurance or some other, On the other hand, if their FOB destination and something happens to them in between shipment, it is the responsibility of the seller to get you a new shipment of them. Absolutely. That's why this is sort of written in your purchase agreement. How do we do it? Now, it's not that every single contract is renegotiated. Like most contracts have, okay, so like think about Amazon, right? They don't specify whether it's FOB shipping or FOB destination. What do they specify? They will take back anything. They also will give you any. Like if you say it didn't arrive, they will take responsibility for it, right? I mean, so effectively, they're kind of expecting, but what are they doing? They're relying on a third-party shipper who validates whether or not it arrives. Okay, so it's not yours until you get it from UPS. Now, the question is, do they fight with UPS over whether it got there or not? That's not your problem. You don't care. You're not, as a customer, all you care is when is it yours, and it's yours when it gets there. Yeah. Yeah, well, yes and no. What if the terms of trade are better? So I understand that buying it FOB shipping is more expensive for you, so I'll cut you a deal. Okay? Or, it's not, yes, if you had two choices, or maybe not. Let's suppose I have a buyer on my end who wants to buy the product right now. Okay? If I have it FOB destination, I can't technically sell them products that I don't own, but I can sell it to them as soon as, and I can record the revenue if I own the product. But if I don't own the product, I have to wait until the next period to record the revenue. So it sort of depends. I mean, it's not 100% obvious. But I mean, the point is, somebody's going to be insuring this, whether it's me or you, and somebody's going to be paying for that. Okay. A few quirky things. They'll try. This is a kind of common question that they'll ask you in a multiple choice. Who owns the goods, or they didn't include these goods. Is that correct or incorrect? So there's something called consignment sales. Now, maybe some of you have been to or seen a consignment shop, which is a place where you bring your stuff and some person, like a shopkeeper, acts basically as the third party and sells it for you, okay? So this is they were more popular before eBay was around, but the idea of a consignment shop is it never belongs to the shop owner. It is your product. They're willing to let you leave it in their store and let other people look at it and provide you that service, and in exchange, when they finally sell it, they'll give you some of the money and they'll keep some of the money. But the idea is the consignment store can call you up and say, look, your stuff's not selling, come and take it back. And it's not their problem, it's your problem. So the inventory doesn't belong to the consignment shop, the inventory stays with the owner. So even though physically it is not in your space, it's still your inventory, okay? If you have an agreement which says, here, you can buy this product, but we promise to buy it back from you. That's one of those sales that companies are trying to make look like a sale. It's not really a sale. So let's say I'm not making my earnings this quarter. I can call you up and say, hey, will you just buy some stuff from me and I'll buy it back from you the next day, on January 1st? Well, if that's the arrangement, then you can't actually call it a sale. It never really transfers ownership. Okay, so it's still my product. On the other hand, it doesn't mean that the customer can't return it. Just because a customer is allowed to return it doesn't mean you can't record a sale. It just means when you record a sale, you have to take an allowance for expected buyback or expected returns. Okay, not buybacks, but expected returns. So as long as you can estimate or predict the return pattern, then you can record it as a sale. On the other hand, if you think 100% of the goods are going to be returned, which would be what it would be like under a buyback, then you can't actually record it. Okay. So installment sales just mean that the customer's paying you over time, basically, in installments. You don't have to defer just because they're paying you in that pattern doesn't mean that you can't record a sale. You don't have to wait till all the payments are received. Okay. However, if there's a lot of risk that they won't pay you, then you need to be more concerned. So if you have this, say, deal which says, well, if you don't want it before the first payment is due, you can return it to us, and that the chance of them doing that, it's like this 30-day trial period and then send it back, and everybody cancels, then you might want to sort of rethink your policy. Okay. But it's not just because it's an installment sale or because it has a high rate of return. It's because you can't actually estimate a genuine sale as having occurred. Okay, or the estimate would say 100% is going to be returned, which means effectively no sale. Okay, so hopefully I can move this guy. I'm not sure I can. All right, well, all right. Everyone have their clickers? Clickers. Take out your clickers. I made some multiple choice questions just because of this. Okay? All right, so now we're just going to try and make sure everybody is completely solid on FOB shipping versus FOB destination, what the differences are, what the products are. Yep. I don't have it. I'll bring some next class, all right? I'll assume you're not participating for just that reason. Okay, so let's say this says, suppose Anderson Company paid its supplier for inventory on 12/20/09. Okay, I don't know why this doesn't seem to want to write. Okay, so on 12/20/09, you pay for your supplies. Okay, and the terms are FOB destination. Now, the purchase price was $50,000 and the shipping costs were $2,500. So price was $50,000. Shipping price was $2,500. Yeah, I'll try. There we go. Okay, so price better. Okay. And the goods were shipped on 12/28. and they arrived on 1/1/10. Okay. So on 12/20/09, what does Anderson, the purchaser of the goods, include in its inventory? Click in, tell me. Is it $50,000, $52,000, or $0 worth of inventory? All right, so we've got some debate here. Is it $50,000 or is it, nobody thinks it should be 52. Oh, wait, I'm giving you some more time. Anyone else want to weigh in? Okay, so we're looking at what do they do on 12/20/09. So what does Anderson have on 12/20/09? Now it paid though, so it cash went down. So something else, like you can't just, you don't get, like they're not giving away cash for free. So what do they have? Okay, some kind of receivable, right? Basically, they have inventory receivable. Do they have inventory? No. Okay, that's technically not their inventory yet. But they gave cash in exchange for the right to receive some goods. Okay? Now, on 12/31/09, what would be the amount of included in their inventory? Okay, would it be 50,000, 52.5, or 0? All right, when I hit 20 responses, I'm respond. Okay, of course I could have the same people responding. All right, so most people think it should be 0. Somebody who's a 0, why do you think, not that you are a 0, somebody who thinks the answer is 0, why do you think the answer should be 0? Yeah. Okay, so what are the terms of this contract? FOB destination. So when are the goods mine as the buyer? When they arrive at the destination, right? So have they arrived as of 12/28/09 or 12/31 when I close my books? No. So I still have my cash had gone down. I have inventory receivable, but I don't have those goods yet. Okay, so I'm still sticking with 0. Yep. All right. Now, how about on 1/10? What then? Is it A? Oh, whoops, hold on. I got to get rid of your other ones and then start a new one. Okay, A, 50,000, B, 52.5, or C, 0? Oh, all right. Who's an A? And who's a B? All right, you're going to be the B. You're going to represent the B camp, and you're representing A camp? All right, why A? Okay, so if it's going to go in cost of goods sold, that would be when I sell the goods, right? So if I'm storing it up for cost of goods sold, you're making her case for her. All right, so what? Yeah. Okay, so make your case. Okay, does it matter if it's FOB destination? Suppose I, the buyer, have to pay the shipping costs no matter what. Do I include the shipping costs as part of my inventory? All the costs to get the inventory ready to go. Because when I'm trying to think about pricing the product, if I don't cover all the costs to get that inventory to my warehouse, I'm going to be charging too little, right? If I just say, oh, well, I just mark it up 5%, I really need to mark it up above and beyond what I actually pay for the inventory. How do I consider, what is the historical cost of the inventory? It's the cost of getting that inventory ready and able to sell. Yeah. The issue of FOB shipping or FOB destination, who pays the cost of shipping, it doesn't matter, okay? I mean, it matters in the sense of, yeah, traditionally, if you do FOB destination, the price of the shipping is embedded in the contract. It is very unlikely that the seller is not somehow charging you for shipping, whether it's implicit or explicit, okay? It doesn't matter. That's not the issue. The issue is, should the total cost to you of the goods, so if you have to pay shipping, whether it's FOB shipping or FOB destination, it needs to be included in the cost of your inventory. If we're on a test, then I would probably try to specify the buyer pays the shipping cost, the seller pays the shipping, like who pays the shipping cost. But here, the presumption is the seller is not, it's the buyer who's paying the shipping cost, so you would include the full 52.5. Okay, so that, now, what would be the difference in your answers here if the terms, so still, the customer is paying the shipping cost. So the buyer is paying for the shipping, but the terms were FOB shipping instead. When does the inventory become the customer's? Okay, so how do they know when it's shipped? No, I mean, I know when it's shipped, you know when how does the customer know when it's shipped? Hopefully they tell you, okay? What if they don't tell you? So they should send you an email, hey, we shipped the goods, right? Or, okay, here's the tracking number. But what if they don't tell you? What's the issue? Yeah. Okay, at 12:31, I have to call them and find out. Because when I close my books, I need to figure out whether any open orders are mine or not mine. And so if they're under terms FOB shipping, I need to find out whether they've been shipped. Okay, so it's true on the 28th, if I got some piece of paper or some invoice which said we've shipped the goods, I could record the entry then. But if I don't, on 12/31, when I close my books, I need to record the fact that that inventory belongs to me. Okay? And so the difference, everything else would stay the same. The only change would be this thing is going to be here. Okay? I would record the full cost of my inventory at the end of the year. Yeah. No, what I said, the shipping costs are paid by the buyer. I just said it doesn't matter. Still, the buyer is paying the shipping cost. Now, if the seller pays the shipping cost, then they probably would just charge you $52,500 for the goods, right? So they're going to pass off, in some sense, the shipping cost onto you. It just might be in the terms would be slightly different. But assuming these are still the terms and the buyer is paying the shipping cost. So the way you could think about it is the following. There could be a third-party shipper, and when they arrive at the ship, and when the customer receives the goods, that's when they pay the third-party shipper for having done their service. Okay? The third-party shipper doesn't really care when they're making this recording. They're just going to insist that when they arrive, they're going to get their check. It doesn't matter when I pay their check. It matters when the inventory is mine and all the costs of the inventory are mine. Okay, so as soon as it ships, I have to start paying for it. Okay. Now we're going to move into something you remember from your first financial class, LIFO, FIFO, weighted average, those things. Now we're going to talk about that. So why is that an issue? So that becomes an issue because so far we've kind of ignored the fact, whoops, I need to change color because now I have a white pen. Let's be green and springy. Okay, so there are two kinds of inventory systems. There's the kind that everybody uses, and then there's the kind that makes intuitive sense, okay? And the one that makes intuitive sense is just impractical and unrealistic. So that's why, even though it sort of seems logical, companies don't use it. So the sort of seems logical one is the perpetual inventory system, which means I make a sale, and at the same time that I make the sale, I record the fact that some of my inventory is going out the door, right? Because that's literally what's happening. I'm making a sale, and I now have less inventory, okay? So when I record a sale, I have cash coming in and sales revenue, and at the same time, I record cost of goods sold and inventory. So this reflects the fact that I have one fewer unit or however many fewer units of product. It means I had a sale, and at the same time I had a cost, and everything is sort of sensible. The problem is I have to know which unit I've sold under this system. Okay, I have to decide every single time I make a sale which product I've sold. Now, it wouldn't matter if prices are constant, because every unit would be effectively identical. Or it wouldn't matter if I only had like 10 items to sell. I can tell the difference between each of those 10 items. So let's say I make 10 tables a year. I know exactly which table I've sold. I know exactly what the cost of that table is because I know how many units of lumber I used and how many screws. And I mean, I can figure out just that one product. But if I have, inventory of all sorts of shapes, sizes, and prices, that just gets really hairy. So instead, what companies have to do is they use a periodic inventory system. Now, you might be saying, oh, well, but now they have such good scanner data and stuff. Yeah, they have scanner data, but every single tube of toothpaste doesn't have its own item number. Did any of you guys read the interesting article about Tide being like a really hot drug trade product? And the reason? Because they don't have actually barcode scanner data on Tide. So Tide is this like high-end detergent. It's not that high-end. It's just laundry detergent. And it's apparently very popular as a payment for drugs on the street. Read the Wall Street Journal. These are the kinds of things you learn, and then you can talk about in an interview. You'd be like, oh, yeah, I know about that. What? I don't know. And you might wonder, why Tide? Well, because Tide is sort of one of the relatively more expensive, and you can easily steal it from the CVS, apparently, because they don't have good scanner data. Read the Wall Street Journal. Okay, anyway. You're like, really? That's in the Wall Street Journal? I'm telling you. Okay, so, or maybe it's in Yahoo Odd News. It could be there too. But, okay, so what you do instead is you sort of say, okay, we have 20,000 tubes of toothpaste that we're selling. Okay, we have all of them. Over the entire course of the year, we sold 18,000 of them. We have 2,000 left, and we just figure out how much the cost of goods sold are. So what we do instead is we record a sale when we make it. So the sale prompts an immediate journal entry. We get cash and sales revenue. But we wait until the end of the period, and cost of goods sold is a closing entry, or is an adjusting entry, excuse me. What we do is we sort of count up what we had at the beginning of the year or at the end of the previous year. We know how much we've purchased, okay? We know how much we've returned, and we know how much we have left. And we figure out how much we must have sold. If it's not in our warehouse or it's not in our stores and we don't have it, does that mean we sold it? No? Where is it then? Okay, so it counts as a cost of goods sold, even if technically our employees are stealing from us or, so other people, or it got like damaged on the floor or whatever. All that counts as cost of goods sold, and it's just considered an additional, if in order to sell 20,000 units of toothpaste, you need to buy 18.5, you need to have 21.5 or sorry, you need to have extra inventory, so be it, okay? the cost of goods sold is determined not by how many units you actually sold, but how much you started with, what you added to it, minus what you got rid of, and what's left. Okay, so cost of goods sold is sort of a determination not so much based on what actually units were sold, but rather the difference between what you started with and what you ended with. Okay, this requires, and now it sounds like a pretty painful thing, and I actually, I was kind of glad that Bill brought this up during his talk, because I always thought when I was a student that it didn't really make a difference which industry you chose. And I remember even telling my good friend who was an accounting major, I said, what difference does it make whether you work for, a retail company or you work for anybody else? I mean, counting shoes or counting batteries, what do you care? That's your, all you do is count, because when you're a junior auditor, some of the jobs aren't that ultra exciting. And there is some inventory counting that has to be done. And Bill completely changed my mind about this. I was totally wrong. You should count shoes if you like shoes, because ultimately that's the industry you want to get into, and you want to sort of flow up, and you want to get to know the people who work at the good shoe stores, and then maybe they'll hire you in-house, and then you'll get a good discount. So, no, I mean, that's not why you're doing, but I was wrong. So, it does matter which company you work for when you first start out, and so you want to choose that very strategically, okay? All right, anyway, so what we're going to, you're like, oh yeah, I'm going to work for the shoe store. Okay, so you have a bunch of inventory at the beginning of the year, you buy some, okay, you may return some, you got to record those returns, and then you count out what you have left, and the difference is your cost of goods sold, okay? That's how you figure it out at the end of the year, and you only do a full count once a year, but you still use that sort of same process for figuring out your inventory at the end, at year end. You have to have some notion of what your inventory is. Now, that said, you don't necessarily have the same degree of certainty as your end of period inventory for the fiscal year end as you do in the different quarters. So the quarterly information is unaudited because nobody's actually counting up the inventory at every point in time. Okay, there's only sort of one official count, and that happens only once a year. Okay, so even if you happen to be one of these perpetual companies, you still have to verify that what inventory you say you have is still there by a physical count. Okay, so everybody's counting. It's just a matter of whether you use that count to determine cost of goods sold or you don't. Okay, so let's talk about how this works, and then probably starting next class, we'll talk about the issues of inventory valuation, which is LIFO, FIFO, weighted average, and then you'll get a little bit more, and we'll move past what we did sort of in basic accounting and try to look at what companies actually use. Because it's true, FIFO, LIFO, and weighted average are easy to understand and fairly intuitive, but they're actually even not that practical and not that utilized. Companies take some sort of hybrid methods and kind of work on them, and so we'll talk about dollar value LIFO as well. Okay, so let's start with, here's a company, and here's what you know about them, okay? They start out, and they have beginning inventory of $100,000. Then, so just straight off the bat, we can say, okay, we don't have to know much, but inventory, 100. Okay, that's what they started the year with. Now, during the year, they're purchasing inventory. Why are they purchasing inventory? Yep. Okay, they're probably expecting to sell more than $100,000 worth of inventory this period, so they need more than they're sitting on. Okay, they have to pay freight charges on that inventory. They decide, some of this inventory is either not what we expected, not up to specification, damaged, just whatever, we don't want it, and they return some of it, okay? The ending inventory on hand is $125,000. They sold $350,000 over the year, and cost of goods sold is $225. Now, this is a number you wouldn't necessarily know if the company was using it's a periodic system. It's because the company is using a perpetual system versus a periodic system that we kind of are given this number. Okay, so let's say we start with the easy case, which is a perpetual system. What do the journal entries look like to get me from the beginning of the year to the end of the year? So what's happening throughout the year, and how do I record that? Okay, now I don't have the ability to make myself a blank sheet anymore. So we'll make them here. Okay, so what happens when I buy inventory? What do I record? Debit inventory, $250. Accounts payable, $250. Okay? I also have to pay for shipping. Okay, what do I do there? Okay, so I'm also adding to my inventory. Okay. I return some of the merchandise to my supplier. What do I do there? Okay, so my inventory is going down, right? So I get accounts receivable because they now owe me a refund. But since I haven't yet paid it, I can just net those two off. So what should I do? Well, I can just get rid of some of the payable. Okay. Now, you might be asking, well, what about the portion of shipping on those goods? The problem is you probably don't get a refund for the portion of shipping unless the seller was the one doing the shipping. So if there's a third-party shipper, they're not going to say, oh, well, you returned this, so we'll give you some credit for the portion you didn't want. So for the most part, we're just going to kind of ignore that. Okay? Now, according to this, my ending inventory is 125. Okay? Now, if I add up 100 and 250 and 10, and then I subtract 10, that would say I have 350. And they're telling me I have 125. How is that possible? I sold 225. Okay, so here, as of here, I would have 350, but I'm selling 225, and I'm ending up with 125. Okay, so as I make the sales, okay, I sell it for $350,000. So what happens? I get cash, and I have sales revenue. And what do I do at exactly the same time? I record my cost of goods sold, which they're telling me is $225, and inventory. And in this sort of system, I'm not figuring out how much I have left based on the count as much as I figured out what my cost was, and therefore I must have 125 left because I started with 350. I sold goods that cost me 225, so unless I'm really bad at controlling my inventory and making sure that it's sort of staying where I think it is, I must have 125. Now, of course, I'm going to have to count up and just double check, but the way I'm doing it is taking a very forward approach. I make a sale, I charge somebody $350, but the units I'm selling only cost me $225, therefore I must have $125 still sitting in my firm. Okay, so this is what I would do under a perpetual system. And I don't need any adjusting entries because all the entries are made at the time that I initially record both the purchases and the sales. Now, let's say I use a periodic inventory system. Then then things are completely different. Okay, let's see if I can get rid of. Oh, okay. Now, what happens is I start out with the same inventory that I did last period. Okay, so I have inventory and I had 100. What happens when I buy more inventory? Well, technically, it's sort of the same thing, right? I just have more inventory. The difference when I use a perpetual versus a periodic system is whether I call it inventory or I call it something else. So instead of calling it inventory, I'm just going to call it purchases. Okay? Now, have you ever seen on a company's balance sheet an account called purchases? No. It's eventually going to have to go into inventory. So part of the closing entry is going to get rid of this purchases account. This is just sort of a temporary account just to sort of tide us over in this process. Okay, so we purchase $250 and accounts payable $250. We have freight in 10, accounts payable 10. So again, all of these things are going to get, these have to go into inventory eventually. It's just we're sort of, being a little bit more specific about where they're coming from and what they are. Okay, and then I have merchandise returns. Oh, whoops, sorry. Hold on. That's not right. Sorry. Oops, that was all right. So, accounts payable merchandise returns, and then sales are the same as they were before. What did I get? I get it on accounts receivable. It's $350. Sales revenue. Okay, so this is what I do along the way. Okay, if you just replace purchases, freight in, and returns for inventory, it would be the same exact thing that I had done before. Okay, so this part's not super exciting. The only exciting part is now. Okay, well, not exciting, but different. So now we just need to take into consideration the fact that I'm telling you that I have 125 here. So I need to close out all of these accounts into inventory. I need to basically take my cost of goods sold out so that I end up with 125,000. So what does that look like? Well, I just kind of get rid of, so I have cost of goods sold that we're going to figure out backwards. Okay? I get rid of my beginning inventory. I can't fit this. Okay? So I get rid of my beginning inventory. I have my ending inventory. I have to close out purchases, $250. I close out freight in, $10,000. I close out returns, $10,000. And whatever's left is my cost of goods sold. So it's sort of like I don't really know what my cost of goods sold is until I figure out what I have at the end, what I started with, what I bought, and therefore what must have been sold. It's sort of like it's almost like a little bit backwards. But the reason I'm doing this is instead of every single time I make a sale, I don't record a journal entry because, to be honest with you, I make a lot of sales. Like the companies that do this, they have lots of sales. And so they don't actually know which products they're selling. They sort of figure out at the end, okay, exactly what did I sell, what do I have left, and this is what my cost of goods sold is. Okay, so hopefully I did this right. This is 360 on this side. This is 135. What is the amount I need to get my journal entry to balance? $225, right? This is not, it's not a coincidence. The answer has to be the same. It doesn't matter whether you use perpetual or periodic, you're still going to get the same amount. It's just whether you kind of go from a forward approach or whether you go from a backward approach. Okay? I'm pretty sure on the slides the solutions are all there. If they're not, you can. So, if you didn't scribble it down with me. Yeah. Oh, absolutely, you use periodic only. Perpetual is for like a company that sells 5 things. Like 5, literally 5. It's like a car dealership. No, not 5 units, not 5 different inventory items. Literally 5 items. So if you, like a jeweler, where everything is very different, right? There's no 2 of the same thing. Or let's say you're like a real estate guy and you have like a specific house and you only sell 50 a year. Well, okay, fine then. But everything else